Tushar Pradhan joins us, CIO with HSBC Global Asset Management. Tushar, markets are telling you that the worst of the economic print is behind us. Would you believe the market, or would you believe your analysis of macro where the core data is not stabilizing, where IP data is not stabilized? So what is the right analogy in this market? Look at what markets are telling you, or look at what economists are insisting on?
Yeah, so very interesting question to begin the day with. I think the answer is somewhere, I believe, somewhere in between, because I don't think that the entire market move is due to some expected turn in the economy as such. I think it's a combination of factors. I think there is a lot of demand for risk assets all over the world, as we see the interest rates and the yields across the world are coming to zero. And there is a need for risk on. And I think given that there is a fair bit of interest globally for assets, including emerging markets, I think India has been a recipient of some flows lately. And on top of that, we continue to receive pretty strong flows in the mutual funds into the Indian equity markets as well. So a combination of demand as well as some improvement in sentiment is leading the market to where it is. I think it remains to be seen whether the economic turnaround is around the corner. But clearly, I think if the early indications of earnings growth is any sign of recovery, I think that's somewhere where the bright spots are. Of course, aided by the fact that there will be a much lower tax rate for most Indian corporates going forward. So I think there is a combination of factors. There is a little bit of a push from the economic side. And there is a lot of pull from the investors putting money into the asset class. And wherever there is demand, obviously the price of the asset class does go up a little bit. I would think the answer lies somewhere in between what you painted at the start.
Okay. Sure. So going forward then, Tushar, I mean, you know, it's difficult in this melee for an investor to kind of figure out whether or not to take that jump. Clearly, sentiment seems to have shifted, and you know, there is still a propensity for risk that's come in today as opposed to what we were seeing even just a few weeks ago. Given the current environment, where would you first look then for opportunities to buy?
I think one has to be cautious in terms of asset allocation. This is clearly not the market to kind of load up in terms of one asset class and one preference. One has to kind of balance the expectation in terms of over what period are you expecting that return. And I think if your period is clearly above 5 years, I think equities as an asset class clearly look to be very attractive, especially the broader markets, not essentially the narrower, more visible indexes as we see. But I think the broader market clearly looks very attractive from a 3 to 5 year perspective. If you look at interest rates, I think that's a very, very interesting situation. If you look at the current yields that we are getting, they're clearly much lower than what we are expected in India. And we see how interest rates have actually gone in the past. But if you look at inflation and how consistently it has undershot in the last few quarters, and if we believe that India is now structurally a lower inflation country than where it was maybe 5-10 years ago, then I think our interest rate scenario also needs to be adjusted a little bit. Keep in mind the real rates in India continue to be one of the highest anywhere in the world, which means that even interest rates here are at risk, which means the bond market as an asset class also for the next 2 or 3 years clearly looks a lot attractive, even if in the last 1 year or so, bond funds have probably given you between 12 to 15% purely on duration. So I think it's a very interesting time to asset allocate. I would focus on the fact that the investor needs to decide whether he wants a diversified approach to investing. And within equities, of course, the broader market in terms of where the valuation are very attractive is where I would really look to begin with.
Just to sort of dwell on that point a little bit more, Tushar, good morning. We were having a discussion earlier this morning that one should even look at individual stocks or individual sectors that have been bear market survivors, that have weathered the storm, so to speak. Is that a strategy that you would concur with when it comes to approaching names in the current environment?
I think a lot has changed in the world as we see, and one of the biggest investors in the world has looked back and decided that if I were to have invested in companies 10 years ago, which have created the biggest market cap today, they didn't exist. So whether it's a Google, whether it is Apple, of course Apple existed, but not in the form that we see it today. And that really puts me into a question in terms of saying that should one look at the current low valuation compared to what these companies used to trade at in the past and try to take a punt. I would still feel that a diversified approach, keeping a little bit of that obviously in one's portfolio, but keep looking for the new ones. Keep looking at where the new trends in terms of market cap is likely to be, pretty attractively valued in the future. I think it has to be a mix in terms of the newer companies and one of the more traditional, weathering all cycles, as you mentioned. Those kind of stocks also need to be part of the portfolio, but not exclusively so. I think the opportunities are clearly somewhere from now in the next 5 years, already maybe in the works or not even there in the markets today. So I think one should keep an open mind. One should look at the trends as they develop, and one should be very, very fairly compensated for the kind of risk that you will take right now.
Is the current market level worth a risk in large cap stocks? I'm not talking about specific mid and beaten down small cap stocks, but for the large cap stocks, at a time when Nifty and Sensex are at an all-time high, does it make sense to take a risk?
I would nuance that question a little bit. It's what I would say that even within the large caps, there is a concentration of companies which are ever popular, and they are clearly trading at valuations which are even higher than their historic highs on an average. So I think clearly there is risk there, though currently the popularity seems to converge there. The only spanner in that argument is the fact that when you get institutional investors, allocators, they don't really go down to stock specific levels. And who is to say that these companies may not sustain, if not even grow from here? So it's very difficult to predict where it is likely to go, because demand also is a function of the whole valuation piece. And at a top level, if they continue to buy one of the largest, most liquid, most market leading kind of companies, then these companies will continue to not disappoint. But that's a risky bet. So I would think that the risk reward is not in your favor given the valuation. But that does not mean that that's going to be a sell. That's what I'm trying to say. So I think one has to be very circumspect. We've seen in the last 2 years, these companies sustain valuation. They continue to remain popular across all portfolios, and they have been expensive 2 years ago. So I think 2 years is a longish period to not have them and continue to have an underperformance versus having them. So I think a difficult question to answer, but clearly there is an absolute nature of valuation, and I think some of them are reaching that. And one can definitely have less of them rather than go overboard.
Tushar, last 5 years, with the exception of, let's say, an ITC or one or two consumer staple stocks, most of the consumer stocks have given good double-digit CAGR returns. Next 5 years, are we in for no returns or single-digit returns or even double-digit returns from some of the Nestle's and the HUL's and the Colgates of the world?
See, I think in the very long run, the price is a multiple of the profits and the kind of rate of growth in the profits that we look at. So in that sense, if you look at the rate of growth in the profits of these companies in the last few years have been much lower than the rate of growth in their stock price. So that has led to this multiple expansion as we see. Going forward, two things will emerge: whether the earnings growth will be much higher, which I feel is not likely, or whether the popularity continues to remain there. In this case, if it sustains the multiple it is there, you are going to make no return or maybe flat return over the next few periods. But if you feel that the rest of the economy continues to suffer, and we are looking at a very, very prolonged period of slowdown in the economy, then relatively they will continue to outperform, even if they don't give you an absolute return. So I think it's a portfolio allocation issue. You have to understand that they're clearly overvalued, which is what we are agreeing. But as a portfolio strategy, they may form part of a portfolio given your view in terms of where the next few months, next few years are likely to be. If you think that we are in for a period of pretty significant economic growth and the broader economy will sustain and improve, then clearly they need it to be underweight. But if you think that it is likely to remain for a much, much longer period, then they need to be a significant part of your portfolio. So that would be one way to look at it.
All right. PSUs are clearly the highlight currently. Everyone's focusing on them with the divestment agenda being top of mind. Of course, we've also seen a fantastic move in some of those key names that perhaps are slated to be put on the block, from a BPCL to an SCI. Concor, of course, the other big one. What are you making of the rally that we've been seeing on some of these PSU names, Tushar? And would that be an investment idea according to you as well?
Yeah, I think there is a lot of value there. I don't think anybody disagrees about the value, but the thing is, how will it be realized? What is the kind of monetization that one gets out of the value? Whether it is by way of a complete privatization, whether there's autonomy. See, you have to also remember that some of the PSUs have a quasi-monopoly in the markets that they operate in. And given over to a much more autonomous management, and given the monopoly, these companies are worth a lot of money. But if the monopoly goes away, the implicit support which is there as part of a government-owned company goes away. And if they have to stand alone on their own, given the fact that some of these prices that they sell and the commodities that they deal in are also mandated by the government, I think it's not a very clear picture. So it's easy to say that yes, they are cheap and they will definitely get a re-rating. But whether all of that re-rating is captured and what kind of company will this be 5-10 years from now remains to be seen in terms of what sort of autonomy, what sort of government regulations, what sort of freedom does the market let these companies operate in. So difficult question. The spectrum of the PSC is also very, very wide. So you have companies in the petroleum sector, you have companies in the gas, you have companies in the banking sector, so on and so forth. So difficult question to answer right now, but yes, there is clearly value comparative to some of the like companies abroad as well, where these companies command a little bit of a premium than what they are trading right now here in India.
All of us have, in a sense, been fooled a couple of times in last 2 or 3 years on prospects of an earnings recovery. Hand on heart, every time we think that earnings recovery is round the quarter, this goes wrong, that goes wrong. This year, everything has gone wrong. What is your sense on when the real capex stroke the corporate recovery will happen?
I think the corporate recovery is clearly being helped by the tax change. Reported earnings clearly will be on a much safer trajectory in the next 1 year at least. And what remains to be seen is whether that translates into a much broader economic move, which again leads to corporate profits being strong and robust for the next couple of years. I think there have been moves in the external context, which also has had an impact on companies which are exposed to these markets. And as you mentioned, every quarter there is one thing or the other which puts things off. And I think that is because of a lack of a concerted economic turnaround. We have seen patches of growth within the economy, and some companies do well and some companies don't do well. But all what we need is for these earnings growth recoveries to really happen and sustain is to have a complete turnaround, and which has to cross the broader market and be across all sectors. That's when we can say that earnings recovery is here to stay. Otherwise, it's going to be pretty stock specific, if at that point of time even sector specific. And this is likely to continue, and these cancellations will on an aggregate tell you again that earnings have been flat. But for some companies, just to give you an example, profit growth has been pretty significant in double digits. Some companies' profit growth has been flat to negative. So when you put that all as an average, we tend to jump to the conclusion that the earnings have been flat, which they have on an average. But I think the economic recovery has not been very uniform. And I think that's what we are waiting for.
Tushar, what's the outlook when it comes to the liquidity situation in terms of the fund flows? While we have seen a pickup attributed to, the corporate tax rate cut, the kind of, environment that we're seeing right now with earnings being better than expected, global flows supportive as well. Where do you and how do you see the trend in terms of liquidity from foreign flows shaping up?
Well, I think clearly there is a risk on. The yields that most of the foreign investors are looking at in their domestic economies are very, very low. There doesn't seem to be any hope of inflation again returning to these economies. There continues to be a very, very difficult growth scenario, especially in Europe, as we see. So given all of that, where does one allocate assets? Clearly, the emerging markets are also struggling. It's not as if they're a bright spot either. But I think given the demographics, given the potential for growth in emerging markets, clearly some of that capital will get attracted into these assets. So in a sense, liquidity is pretty much out there, and there doesn't seem to be any quantitative, as we call the counter to easing, which happened. The quantitative tightening had a very short period, and we are not seeing any economy, any central bank signaling that we will take liquidity back out. So I think liquidity will sustain. It will continue to remain pretty much adequate, at least for the foreseeable future.
So fantastic to have you on ET now, and certainly hope that the coming year or the current year is much better than what it has been. At least it is much better than the year gone by.